Hi guys, this is Mansfield from Mac Partners. Today I would like to share with you about our thoughts on the stock market. Over the past few months, we've seen most of the major stock indices slide down. Some of them even dropped by about 50% from the top. We receive a lot of questions from our clients. They ask us about why there is no buyer in the market. Well, obviously, the large outflow kills most of the buying interests. Have they reached a bottom? No, not yet. But we may be close to an important tradable bottom. To further elaborate, we'd like to talk about one investment myth. Most investors believe that cheap valuation equal to a good time to invest. But we don't think so, because valuation is one of the small factors. Since 2008, capital flow has been a dominant factor because of the QE from the US. Under the QE program, there are surplus US dollar flood into the emerging market, creating financial asset bubbles. To understand more about the mechanism, let's look at the capital inflow between the investor and the central bank. When there's large inflow, investors sell US dollar to the central bank. And central bank receive the US dollar and issue the local currency to the investor. At the same time, central bank will put all these new issued local currency into the liability of the balance sheets. They will use the US dollar from the investor to buy the US Treasury, which will then put under the asset side of the balance sheet under the foreign reserves. So therefore, when we see the inflows, foreign reserve increase and the domestic liquidity improves. This is a very interesting concept because it is difficult to measure the capital inflow, but we can use the change of the foreign reserve as a measure, as a proxy to the inflow. Let's take a look on the World International Reserve ex-US from 2008 to 2022. Over this 13 to 14 year period, World International Reserve ex-US increased from 6.7 trillion to 12.9 trillion. Thanks to the QE1 in 2008, QE2 in 2010, QE3 in 2012, and lastly, QE4 in 2020. What will the impact of these large capital inflow? You will see the increase in the foreign reserves and local currency start to appreciate against the US dollar. At the same time, stock prices increase. There will be a credit boom, and at the same time, the local interest rates will go lower. We will see a pickup in the economic activities. But how about outflow? Outflow, when we see the capital outflow, obviously the foreign reserve will decrease, local liquidities tighten, local currency depreciate against the US dollar, and the local currency yield is going to go up. Investors are selling the stock market. They're selling stock for the cash. The faster the flow, the bigger will be the impact. Then now we look at why capital outflow started in February 2022. That is mainly because we start to see the US rates going to pick up, and hence there's a widening of the interest rate gap between US to other currencies. And also the US Fed has changed the tone to become more hawkish. They also confirmed that they're going to continue the quantitative tightening. How fast is the current capital outflow? Let's take a look on that. In terms of inflow, over the past 24 years, the inflow is about 1.1 trillion. That is equal to 42 billion per month. And we look at the outflow, which only happened for the past 7 months. The amount is about 1 trillion, equivalent to about 147 billion per month. The speed of the outflow is about 3 times as fast as the inflow, which that is the reason why we don't see any rebound over the past 7 months on the stock market, because investors are selling the stock for cash. Let's further look at 2 more examples. South Korea in 2022, the inflow actually turned to outflow, happened in 2021. And during that period, Kospi index down about 48% in US dollar terms. Another example, China from 2014 to 2017. The inflow started to make a U-turn in 2014, and then outflow intensified in 2015. And then we trigger the correction of the CSI 300 index, which down about 48% during that period. And then the CSI index recover thanks to the change of the float in 2017. When we start to the inflow come back, stock market actually performed better. So these 2 evidence represent that capital flow is very important, in particular during the QE age. So going forward, when will the capital outflow end? Well, we think this is only just the beginning. 3 reasons for that. The current outflow is about 1 trillion, which only about 16% of the 6 trillion inflow over the past 13 years. And also when you look at the US CPI number, confirming that the uptrend is still intact. So the US interest rate hike cycle has not finished. There could be more to go. And then the US QT program should speed up the capital outflow in the next few quarters. So therefore, any market rebound is likely to be short-lived. This is the end of today's video. If you like it, please give us a thumb up. Don't forget to push the subscribe button so that you won't miss any video coming in the future. Thank you for your attention. Bye.